Uh, we're live, fellas. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Andy Summers of Summers Value Fund. He's a healthcare specialist. How are you, Andrew? Good to speak to you.
I'm well. Thanks for having me today.
Welcome. Let's just talk very quickly. Talk to us about your strategy and your philosophy in sort of a healthcare value focused fund.
Sure. So I've spent the preponderance of my career in the healthcare sector. So that's why we focus on healthcare. But the Summers Value Fund takes a concentrated long-term approach to investing in the healthcare sector. We uh, primarily look for special situations or companies that are off the beaten path or underfollowed, underloved. They're usually out of favor when we buy them. And then we like to hold them for a long time until that misperception is cleared up in the market. We started in 2018. Uh, I spent most of my career at large asset managers, including Invesco Funds and Janus Capital. I'm based in Denver. I've always been in Denver, but because of my healthcare orientation and background, that's what we focus on in the Summers Value Fund.
What are some of the uh, unusual things about healthcare that perhaps generalists or folks in other sectors don't know or understand that they need to know to survive and thrive?
Yeah, healthcare is a very complex sector, and the complexity really stems from the regulatory environment and the constant change that's occurring on that front. There's different policies coming out of Washington at any given time. We've seen a lot of that so far under the Trump administration. But what's happening at the FDA is another sort of angle to it, and just sort of the regulatory path to getting drugs and devices to the market. So you just have this kind of sort of constant change happening on the regulatory front that adds complexity that most generalists, I think, are not necessarily used to. And then, of course, you have like commercial dynamics that are always changing as well. The payers play a very significant role in the healthcare sector. So you have to understand what they're willing to pay for, what they're not willing to pay for, and how that might be changing. On the commercial side, of course, on the government side, they're a big payer as well. So you have to know how CMS is viewing drugs and devices and the changes that are coming out of CMS. So, there's just a lot to really digest in the healthcare sector, and that can create complexity that would make maybe generalists somewhat uncomfortable.
I think before we came on, I was just saying that I'd seen some chatter last year on Twitter that healthcare was particularly cheap relative to the rest of the index. And it seems to follow this long cycle where I can't remember, I think it might have been early 2000s where it was comparably cheap and then it went on for a very good 2 decade run. And it seems to have been a little bit weaker more recently to the point where it looks like it could be a very good opportunity. But could you perhaps narrate for us why it's had that long period of outperformance and what's caused that sort of recent period of underperformance?
Yeah, so healthcare did really well, I think, coming out of the financial crisis. Really, 2010 to 2015 was a spectacular period for the sector. There was a lot of uh, merger and acquisition activity happening at that time. There were a lot of new product launches, exciting new product launches happening at that time. And so that drove a lot of interest in investing in healthcare. Biotechnology specifically did extremely well in that period of time, mostly because of the innovation that was coming out of that part of healthcare. But and then in 2015, things really changed. The sector kind of peaked 2015, maybe into 2016. There were more patent drugs coming off patent in that period of time, which created headwinds to growth. There was less innovation happening in that period of time. I think you saw some reduction in M&A activity. I know from 2022 to 2024, we saw quite a big drop off in M&A activity. So just some of these things stacking on top of one another created a situation where the sector underperformed for a period of time. So we would agree with you, at least on a relative basis. The sector looks very attractive compared to the broader market.
Yeah, GMO had a piece recently on that was talking about this healthcare and and the valuation versus the market, and they had it. They showed a chart that went back to the 1980s, and it was like I think it's if I look at it and squint now, it's minus 40% below on a relative basis, and this is sort of
Yeah.
their composite metrics that they'd use of like PE, normalized price to sales, cash flow, dividend yield. Uh, but the other interesting thing they had was a chart in there that was um, healthcare spending as a fraction of GDP. And they had all of the other OECD nations, and they're kind of like all together on this, it's an upward trend. And they're now somewhere in the 10% category. And the US was up at like 18 plus as this
Yeah.
outlier, ramp above everyone else. What, first of all, what do you make of that, I guess? And then second, is that sustainable? Is that actually argument that we're maybe overspending as a society on healthcare relative to others, and maybe that could be a headwind, which previously was a tailwind? How do you think about that?
That's been a long running debate in the healthcare sector, whether or not we're overspending relative to the rest of the world. I don't really think that's open to debate. Clearly, we are based on the data. But there's a thesis that the United States is subsidizing the rest of the world with our innovation, and that innovation is expensive. And because of that, we charge high prices for the innovation that we bring to the market here in the US. Countries outside the United States, Western Europe, and so forth, they pay much less than we do for those drugs. And so there's an idea that we're sort of sponsoring or subsidizing the rest of the world with the R&D that's taking place inside the United States. So I think that's something that the Trump administration is sort of taking head on, which other administrations did not necessarily. So now, for the first time, really in the 30 years that I've been doing this, you're seeing price concessions on the part of drug companies in the United States. The Inflation Reduction Act is driving a lot of that. And so that's put some pressure on the sector, especially on drugs specifically, that we just haven't seen historically. But it all feeds into the fact, I think, that we are, as a nation, spending quite a bit more than other developed nations around the world.
To your point, though, the other side of that coin is that there are drugs available in the US that just aren't available in the rest of the world. And until they're approved by whatever their local regulator is, they're just not available. And if they're not, they want to pay a lower price, but if the drug company doesn't agree, they're just never available. So the US has a bigger menu. But my question was more about biotech, uh, similar to the trend that we saw in healthcare, where it looked to be unusually cheap. I thought I saw some chatter last year too that biotech was looking unusually cheap too. Is that true? Why do you think that that's occurred?
Yeah, I think that is true. If I had looked at my portfolio specifically, a year ago, we had about 5% of the fund in biotech. And fast forward to today, we have about 40%
Mm.
of the fund in biotech slash pharma. But it's been a real sea change for us beginning about a year ago. And I think to your initial point, you're spot on. The sector was, or the industry was out of favor for a number of years, and that led to undervaluation. But more importantly, what I'm seeing today is, you know, biotech has always been about innovation cycles. And right now, we're on the cusp of a really strong innovation cycle within biotech. And usually, what that does is it drives broader investor interest, so generalist interest, and it also drives more M&A. And so I think, and the industry has matured a lot. And a lot of these small cap companies today have matured to the point where they can launch drugs on their own. And that didn't necessarily happen 20 years ago. They almost always partnered with a bigger pharmaceutical company to commercialize something that they innovated internally. Well, these days, I'm seeing a lot more biotech companies that are more than willing and capable of bringing these innovations to the market on their own. And so it's created a backdrop, I think, that's pretty exciting today and very investable. And so that's why you've seen us move more broadly in that direction.
How do you think about biotech? Because there's one way where if you're fairly unsophisticated investor from outside, looking at the biotechs, maybe just looking at how much cash they've got on the balance sheet, taking a basket approach and knowing that some are going to work, some aren't going to work, and hope that you get more winners than losers at the end of that. Or you could take a much more targeted approach. So how do you think about biotech and what are you looking for as a sort of catalyst or the thing that piques your interest?
What if I got a D in biochemistry in school?
Well, everything we do at Summers Value is targeted. So we are a concentrated fund. We own roughly 10 positions at any given time. Maybe it's eight, maybe it's 12, but something around 10. And so because we're so concentrated, we take what I would call a more de-risked approach to investing in biotech. So I'm not a scientist by background. I don't invest in science projects as an investor. So something that's phase one, phase two is just way too early for us. There's too much risk. Something that's completed phase three and perhaps is waiting approval by the FDA or has been approved by the FDA is waiting commercialization. That's about as early as we will go in the process. But by waiting until the very end, we take a lot of the development risk out of the equation. And then at that point, we're really accepting commercial risk, which is something that I'm much more capable of understanding. And so because of our approach and the way it's designed, we are able to take a more targeted approach to what we do in biotech, and that applies to anything we do in healthcare.
You mentioned that you expected an innovation cycle to kick off or in an innovation cycle. What's driving that most recent innovation cycle?
Well, I just think historically these things have come in waves, right? Where you get a lot of investment, which leads to a period of time where you see the other side of that, which is the productivity of that investment. And right now we're just seeing a lot of new drugs coming to the market. The FDA has been relatively benign to the industry, which is always helpful when the regulator is taking more of a laissez-faire approach. That's always helpful. I've been investing in periods where that hasn't been the case, so that's also helpful to get new drugs to the market. But I think it's just more of a cycle, and right now we're in the positive early innings of another innovation cycle. Now, the one thing that I would point out, and I think this is incredibly important, and it's more of a macro observation, but we're sitting here today in 2026, and between 2026 and 2030, there is a pretty significant patent expiration wave affecting large cap pharmaceutical companies. In fact, it's the biggest patent expiry wave the industry's ever seen. So just to throw something out there at you, of the top 10 pharmaceutical companies around the world, five of those 10 are going to lose 50% of their revenues between now and 2030.
Oof.
So if you appreciate that as a backdrop, you'll understand why more M&A is coming. It's very obvious. The way that these companies are going to get out of this hole is by acquiring the innovation that's happening in biotechnology today. And so I'm very optimistic that we're at the beginning of a multi-year wave of M&A. And alongside that, of course, is this innovation cycle that I just described, which I think will feed that M&A cycle.
At the risk of revealing how little I know about healthcare, what are the impacts of the mRNA or AI on? I know those are two different things, but
What are you talking?
I don't mean together. I just mean mRNA is I guess that's a 5-year-old technology now, but that seemed to be like something that might spur an innovation cycle if it's a different way of delivering a drug. And then AI is a different way of analyzing the data. And I did preface that by saying at the risk of illustrating how little I know about healthcare.
Yeah, those are pretty broad topics. I don't know that I'm qualified necessarily to give
Okay.
you an opinion on mRNA and the impact that's going to have. That's a really small subset of biotechnology. The innovation that we're seeing is pretty broad-based, actually, across different therapeutic categories within healthcare. Um, we are seeing some leading edge technologies emerge in oncology, specifically immunology, some other areas that are driving some of that innovation. But I don't, and AI, that's also pretty broad. Companies are using AI now in their sort of early stage modeling of molecules that they're looking at bringing to the market or bringing into development, which I think over time will increase the hit rate or decrease the development risk of those assets. But I think it's still pretty early days as far as how that's being utilized inside of drug companies to improve their hit rate, if you will, for drugs that they're developing. But it is certainly coming, and it's certainly going to be something that you're going to see more usage of over time.
How about GLP-1s as a kind of a massive headwind actually for all of if they do what they say they do, which is fix a lot of sort of like chronic diseases of abundance that I think is the healthcare system addresses a lot of those today. If GLP-1s actually do eliminate some of that, those chronic issues, uh, where does that leave us then is it, is there as much healthcare as we need then if we're kind of gotten better at the very upstream part of it?
So the GLP-1 drug class is probably the closest thing I've ever seen to a magic pill that the industry has developed. So
And I would back that up with some anecdata of I was at the JP Morgan Healthcare Conference a little bit last week in San Francisco, and that GLP-1s were still everyone wanted to talk about them the whole time.
yeah, so they have metabolic benefits, so they lower your weight. They have cardiovascular benefits, so they lower your blood pressure, they improve your lipid profile. They have cognitive benefits, which I think are maybe still more on the early side of being totally played out, but they're being looked at in dementia and other cognitive diseases. But I mean, literally, they lower cancer rates, because again, people are losing weight, and obesity is one of the primary drivers of cancer. So again, the closest thing to a magic pill that I've ever seen. The side effect profile is relatively benign. The first 30 days can be tough on your GI tract. So you might have nausea and vomiting for your first 30 days. But if you can get through that, the long-term impacts are profound. And if you're paying attention, Novo just launched a higher dose of their oral GLP-1. It's oral Wegovy. And interesting side note, so this goes back about 6 years, but I did a lot of work on this drug class before it was really sort of widely understood to have, it's going to be the biggest drug class of all time. We owned a company called Emisphere, which got a royalty on the oral form of Wegovy. And so I was very early to this drug class. I did a lot of research back then. Literally spent a year of my life, understanding the profound impact that this drug class was going to have. And unfortunately, Novo Nordisk bought that from us in 2020. But
For too cheap, I imagine.
well, if it was still around today, you could imagine what it would be worth. But
Yeah.
yes, I would argue they sold it too cheap. But yeah, we had a very good idea that this was going to be the largest drug class of all time back then, but there were very few small cap ways to get exposure because obviously Novo Nordisk and Eli Lilly being, very large companies aren't really on my radar per se. They should have been, but they weren't.
Andy, you've had some experience with activism in healthcare. Can you tell us a little bit about that?
Yeah, so I've run two activist campaigns in my time at Summers Value. I would say one was an abject failure. That was number one. And then the second one has been a very big success. So the failure ultimately failed because the business wasn't a great business. Um, I was able to get a board seat and was able to drive positive change, but the mistake I made was the business was not high quality, and it was more fragile than I expected, and it encountered too many headwinds. And I was only on the board there a year. I stepped off and sold my position, but sold it at a loss. But the second, I used the learnings from the first campaign, applied it to the second, was far more successful with the second. That was in 2021. Um, I'm on the board of that company today, but it's been a fantastic experience. We have a wonderful management team and board of directors there who are, performing at a very high level, and I'm very pleased with how that has performed.
And talk to us a little bit about your board positions.
Well, I'm on the board of a public company today called Electromed. It's a small medical device company based just outside of Minneapolis. And I'm also on the board of another medical device company called Restore 3D. They're a private company. They're based in Raleigh-Durham, North Carolina. And the way I got involved with Restore 3D is we led the Series A round in 2024, and I took a board seat alongside that capital raise. And then we also participated in the Series B raise last year, which was led by Partners Group, which was one of the largest private equity firms in the world. And now they're also on the board. But Restore 3D, it's interesting. So we have the main fund, but we've also launched what we call deal funds around the main fund. So the first deal fund we launched in 2021, that was the Activist Fund. We closed that fund last year. That fund was very successful. So we
Are
ended
these
up returning.
single idea SPVs?
Yes, exactly.
Okay.
So deal fund for us is an SPV. Uh, but so that fund is gone now. Deal funds two and three for us were investments in Restore 3D, the private orthopedic company that I just described.
And what do they do?
Yeah, it's really interesting. So the orthopedic market today is dominated by Stryker, Zimmer, uh, J&J, and a few others. And if you need a new hip or a new knee and you go find a surgeon to do the procedure for you, that surgeon's going to take some measurements while you're on the table. They're going to go to the stock room. There's a floor to ceiling inventory of different sizes of these hips and knees, and the doctor's going to say, Mr. Carlisle is a size 5, so that's what we're going to put in him on
That's
the table.
small and weak, Toby, by the way.
That's the biggest size that they have.
Yeah. And then, 90% of the time that works fine, right? Maybe 95% of the time that works fine. The patient has a good outcome and, gets back to their daily life. However, in 5 to 10% of the cases, it doesn't work. It doesn't fit the size or the shape, and the patient has a really bad experience. So what we do at Restore 3D is we're personalized orthopedics. So if you go see your surgeon, you say, Mr. Taylor, you need a new hip. You need to go get a CT scan first. You get the CT scan, it gets sent to Restore 3D. We use AI and machine learning to make a patient-specific implant for Jake, and then we 3D print it in Raleigh, Durham, or outside of Boston. We have two manufacturing facilities. We 3D print it, and then we ship it to the surgeon, and the surgeon will put it in. It's I would say it's a more contemporary business model. I think it makes a lot more sense. Everybody's size, shape is very different. And so we think that everyone deserves personalization in orthopedics, and that's what Restore 3D is delivering. Now, Restore 3D also does ankles and hips. I'm sorry, ankles and shoulders, and that's probably where we're most differentiated. If you think about your shoulder or your ankle, there's a lot of anatomy there relative to your hip and your knee. And so that's where personalization can really create better outcomes for patients. And those where our products are most unique. But Restore 3D did almost 90 million of sales last year. We'll do well north of 100 next year, and we're planning an IPO in the second half of this year. It's been a great experience for me. There's a fantastic management team involved. You know, the longer I do this, the more I appreciate that people matter. And the management team at Restore 3D has sold three companies previous to Restore 3D. They've always sold them to publicly traded companies for really good exits to their investors. So this is their fourth iteration together as a team. I think that matters a lot. But I've also been able to kind of watch from the inside what it's like for a company to go public and just the bankers and how they interact and the preparation that's happening in advance of that. So it's been a great experience so far.
What sort of market cap do you expect? I mean, I don't want to get the pricing. I'm
Whoa,
just sort
whoa
of
there,
interested
buddy.
in like going public as a small or mid, or I don't imagine it's a large, but you know, there's been a lot of talk about a lot of companies foregoing that, trying to stay private for longer and raising more and more VC so that they become public as large caps to sort of escape whatever sort of, you know, is going on in small and mid. Does that factor into the equation at all? Do you consider that?
Yeah, so I think in the case of Restore 3D, we're in a very good position because we have now the backing of one of the largest PE funds in the world, and they're very prepared for the company to stay private longer and support the business along the way. So we have, I think, a very attractive position where we could stay private longer if we wanted to. Obviously, that's a broader trend in the market that companies are staying private longer. But having said that, I think you know, we would entertain going public. We are in fact moving down that road as well. So if the market is open and the market is you know, attractive, we will push that button and go public. Um, it's interesting, right? As a small cap investor, the pond that I fish in has been shrinking for
Right.
25, 30 years. You see companies being acquired all the time, but there's not a good sort of backfilling of those companies through IPOs or other mechanisms. So I view it positively as a small cap investor. I'd like to see more companies go public over time, but I think we're in a really advantageous position where we don't have to, but we will if the market environment is right.
Let me just give a quick shout out, and then JT will do some vegetables at the top of the hour. Toronto, Valparaiso, Breckenridge, Snohomish, Boise, Lausanne, Switzerland, Asheville, Tampa, Hunter Valley. Good for you, living the dream. Bangalore, Morrow, Ohio. Oh, got a hard one here.
Sound it out.
Kapavoga,
Okay.
Iceland. Is that real? Are you in Iceland? Orlando, Gothenburg, Sweden, Nashville, Tennessee. Tallahassee. Got some good questions in here too. We'll come back to Andy after the vegetables.
All right. So let me start with a perhaps strange claim that most market failures don't come from bad ideas. They come from good ideas that work too well and get taken too far. They come from systems that become so good at rewarding the right behavior that actors learn how to fake it. And in markets, we like to believe that we're filtering for quality, like better businesses, better technology, better management. But what if that belief might be backwards? What if markets don't select for truth at all? What if they select for what looks like past success? And that brings us not to Wall Street, but to a Russian botanist who was studying weeds. And in the early 20th century, a Russian botanist named Nikolai Vavilov noticed something strange happening in agricultural fields. It's worth sharing a bit of background on Vavilov first before. He wasn't just a theorist, he's actually quite an ambitious field scientist, and he traveled relentlessly and led extensive expeditions across dozens of countries, walked through the Fertile Crescent, the Ethiopian highlands, the Andes, Central Asia, and he identified what he called centers of origin, which were regions where crops like wheat and rice and maize and potatoes first emerged and where their genetic diversity was the greatest. And to protect this diversity, he created what was in effect, basically the world's first modern seed bank. And he believed that humanity's long-term survival depended on preserving that variation. And being Russian, of course, here comes the tragic part of the story. In the Soviet Union, agricultural science was very politicized. And this pseudoscientist that you probably heard of named Trofim Lysenko rose to power by telling the regime what it wanted to hear, basically that crops could be forced to improve quickly through ideology, really, not genetics. And that belief aligned perfectly with the political incentives. Vavilov disagreed, and he thought that biology actually had some rules and constraints around genetics, and you couldn't will productivity into existence. And for that, he was arrested, and eventually he died of starvation in a Soviet prison in 1943, which ironically during a famine, by the way, while the seed bank that he built was protected by his colleagues, who themselves actually starved rather than eat the seeds that they were guarding. So enough Russian sadness. Let's go back to the farm. Farmers, are planting wheat and barley and rye, and they're carefully cultivating these crops. And they're doing what farmers have always done, and they're removing the weeds. And over time, something really unexpected happened. The weeds didn't disappear, they adapted. Certain weeds began to look like the crops themselves. Their seeds became similar in size and shape. The stalks bent in the same way. Their growth cycles synced up with the harvest schedule. And the weeds that survived weren't necessarily the strongest or the fastest growing, but they were the ones that best impersonated what the farmer wanted to keep. And this phenomenon became known as Vavalovian mimicry after Vavilov. So whenever a system tries to filter, optimize, or reward certain traits, the environment adapts to it. And over time, the participants evolve to look like whatever passes the filter, regardless of whether there's underlying substance to it. So biology does this, social systems do this, and of course, financial markets do this. So markets like farms are selection machines. Narratives, benchmarks, screening, they determine what survives and what gets removed. And investors are constantly trying to separate the signal from noise, the wheat from the chaff. But this act of filtering can change what gets produced. So once a market starts rewarding a specific trait, growth, margin, ESG scores, AI exposure, index inclusion, the participants don't just compete honestly on fundamentals anymore. They adapt their appearance, they evolve. So the most obvious form of this Vavalovian mimicry in markets occurs through narratives. As Morgan Housel has said, every market valuation is a number from today multiplied by a story about tomorrow. And when the market becomes hungry for a specific story, companies learn to speak the language of that hunger. And they, think back to the dot-com bubble, late 90s, it becomes impossible to raise capital basically unless you were an internet company. And so firms adapted. Traditional businesses threw .com onto their names, launched a website. Pitch decks now are about eyeballs and not about revenues. Valuations exploded, not because really economics had changed, but because the desired phenotype had. The same logic plays out during every SPAC boom. Sponsors reward massive TAMs, aggressive forward projections, visionary storytelling. So the companies evolve to meet those expectations, and these financial projections get stretched further into the future. Narratives get bigger. Reality sort of becomes optional for a while. And of course, we're seeing this now with AI in a lot of ways. Every company's added AI to its product roadmap. Earnings calls, or something like 60% of recent earnings calls in the S&P 500 have explicitly mentioned AI. And there's another mechanical version of Vavalovian mimicry that happens inside the index. So today, something like half, I don't know, I feel like the number moves around, but half the US equity ownership is tied to passive strategies. That means inclusion in an index isn't just really a symbol. It determines your liquidity, your cost of capital, the immediate valuation. So these companies adapt. They structure their share classes to meet index eligibility requirements. They manage float and buybacks to optimize weighting. They time their splits or spinoffs and corporate actions around rebalancing schedules. So this capital flows towards what's included, and it gets reinforced then by benchmarks. And then, of course, you have closet indexation that happens behind that furthers the momentum with concepts like, I don't know if you guys have heard of this, like completion portfolios as a thing in big allocators. Basically, like you don't want to lag too much the S&P. So these assets are evolving not really necessarily to be better businesses, but to fit the benchmark mold. And this crop is the index, and the weeds are the companies reshaping themselves to look more like it. So I want to bring this back to markets by quoting some Howard Marks for you. And this is from his second Dare to Be Great memo, which I believe came out in 2014. And it's worth a read. It's quite good. So here's Marks. For years, I've posed the following riddle. Suppose I hire you as a portfolio manager, and we agree you will get no compensation next year if your return is in the bottom 9 deciles of the investor universe, but $10 million if you're in the top decile. What's the first thing you have to do, the absolute prerequisite, in order to have a chance at the big money? And he says no one has ever given the right answer before. Do you want to give a guess as to what what he's about to say? Toby, that's the question for you.
Yeah, I have no idea. I'm thinking about the answer. I imagine you just that's got to be momentum, right? In the short term, you look at what's worked this year.
Well, that's not Marx's answer. Maybe that's 15
I'm
years of bull market talking.
What do you think, Andy? You got a view?
Yeah, I think you have to be willing to take some risk, higher risk portfolio.
So here's Mark's answer, quote, the answer may not be obvious, but it's imperative. You have to assemble a portfolio that's different from those held by most other investors. If your portfolio looks like everyone else's, you may do well or you may do poorly, but you can't do different. And being different is absolutely essential if you want a chance at being superior. In order to get into the top of the performance distribution, you have to escape from the crowd. Non-consensus ideas have to be lonely. By definition, non-consensus ideas that are popular, widely held, and intuitively obvious are an oxymoron. Thus, such ideas are uncomfortable. Nonconformists don't enjoy the warmth that comes from being at the center of the herd. Further, unconventional ideas often appear imprudent. The popular definition of prudent, especially in the investment world, is often twisted into what everyone does. So that's the connection. Vavalovian mimicry says, once a farmer rewards a certain look, weeds evolve to copy that look. And Howard says, if you want top decile returns, your portfolio can't look like everyone else's. So you put them together and you get a simple warning. The crowd doesn't just make you wrong. It trains the world to say what looks right now. That's where bubbles come from. The moment that the weeds learn the crop's phenotype and express it. This is why non-consensus ideas often feel imprudent, because prudent in markets just means looks like the crop. But if your goal is an enviable long-term results, that type of consensus prudence is actually the enemy. You have to think for yourself and resist the Vavalovian mimicry.
Well, I'm sorry that I failed that test. I think Howard Marks wrote that. I think it's clear that he wrote that in 2014 because that hasn't been true since 2014.
Right.
It's been a large cap growth market since, but over the very long term, Howard Marks is right, and eventually we go back to that kind of market. We may already be there. It may have started in October last year.
Don't jinx it.
Good one, JT. Oh, I don't have any influence with the
No.
man upstairs, dude. I'm just saying. Um, we had a couple of good questions here, Andy. This is from the listeners. What are Andy's thoughts on the pharma supply chain re China and active ingredient manufacturing?
I'm curious
And
about
then
that as well.
there was a follow-up with respect to rapamycin, particularly.
Mm. Also that one.
So we're talking about contract manufacturing?
Active ingredient manufacturing is the question, but
I would say more
answer.
generally like biotech in China and like their capabilities starting to approach the US and what that means for the industry.
Yeah, I think that is true. I went to China multiple times when I was working at Janus, and I can tell you, going back to 15, 20 years ago, when you went over there, it was very unimpressive. Um, it was the Stone Ages compared to what was happening in the United States. Fast forward to today, you have very sophisticated companies operating out of China. The regulatory environment over there has sort of fostered uh, an innovation period that you know maybe has caught them up very quickly to where we are. And you're seeing today more US and European pharma companies sourcing compounds from China as a result to bring them to the US and to other developed markets. And I think that speaks volumes about how far they've come in a short period of time. Obviously, we're seeing onshoring as a trend. And so you're going to see more manufacturing done here. You're going to see more active ingredient sourcing done locally over time. And so I think that's something to be aware of. But as far as drug development is concerned, China has caught up in many ways to what we're doing in the US. And you're seeing that just in the deals that have been struck recently between big pharma and some of the companies over there to bring those products to our markets.
Andy, you're a long short investor. Can you talk to us a little bit about what you look for on the short side?
Yeah, so I short for absolute performance. I don't short to hedge, just to be clear on that. And I learned a long time ago the hard way that shorting something because it's expensive is a terrible strategy. So we don't do that. But what we do is we look for things where market expectations might be very divergent from our internal expectations. And the way that we express that generally is through new product launches. That's where I see the most inefficiency. The market either gets it wrong by being wildly over optimistic or wildly under optimistic. And so that we can create a divergent view there sometimes that we can take advantage of on the short side. That's where we've made most of our money since inception. But generally speaking, we're very selective on the short side. We might have zero shorts, we might have three or four, but we don't have 10 or 20. I think one of the ways that the hedge fund industry has failed is by obviously the fees are higher, and a lot of managers justify those fees by having too many short positions on at any given time. And I know from experience that it's just very, very hard to have that many good ideas at any given time. So I think many managers don't make money on the short side long term as a result of that. I'm very proud that we've made money on the short side since inception. We've made money most years since inception, but I believe the key to our success is selectivity and not feeling the pressure to have X number of positions on at any given time and having the benefit of waiting for the right opportunity to present itself.
Would you be able to walk us through a position on the long side on the way you're thinking? It doesn't have to be open. It can be something that you closed, but just so we get an idea of how you think about some of these positions.
And assume a fifth grade level of understanding of biology.
Yeah. So maybe for the audience, I'll talk about something it's kind of boring actually, and easy to understand. But we've been invested in a company called UFP Technologies since 2020. And UFP Technologies is a manufacturer of medical devices, an outsourced manufacturer. So companies like Stryker will contract with UFP Technologies to manufacture their products on their behalf. Um, Today, UFP's biggest piece of business is with Intuitive Surgical. So they produce, sorry, all of the pouches and drapes for the Da Vinci robot. They do that out of the Dominican Republic. But what what drove my interest originally is at the time, UFP Technologies was a 200, maybe 250 million market cap, and they were categorized as an industrial. So they were slowly migrating from manufacturing, let's see, aerospace products, for example, and doing more medical device manufacturing. They were somewhere around 60, 70%, maybe 60% of the business in medical devices and the rest in other. But their GICS code was industrial. So as a healthcare investor, I had never heard of them. I think most healthcare investors at that time wouldn't have known who they were, but I could see that they were migrating to be a healthcare company. And I could also see that the multiple they were trading at was far below that of a healthcare outsourced manufacturer. So there was sort of an arbitrage there between an industrial manufacturer and a healthcare manufacturer. And so at the time, they were trading at maybe 14, 15 times earnings. They had a lot of cash, no debt. Um, but what was unique and interesting about the management team there, going back to management is extremely important, is they had a history of acquisitions. And very few companies have the DNA, have the culture to be consistent and, uh, obviously positive acquirers of other assets over time. Most companies fail. I think empirically that's proven out. But this company had a track record of success. And because the industry was so fragmented, it was primarily comprised of mom and pop operators. You could just see they had this long runway to make acquisitions. The management team had an algorithm that was extremely attractive. They were buying things at 4 or 5 times EBITDA. They were integrating them into their business with the one goal of always becoming more valuable to their clients. And I just think that culturally, that drove a lot of their success. Let's always become more valuable to our end client. And so what's happened since 2020 is today they're 90+% medical manufacturing. So now they're considered to be a healthcare outsourced manufacturer, which has improved the multiple. They've grown earnings much faster than expected because they've layered in acquisitions over time. And so it's been a very good stock for us. We've sold quite a bit of it at this point, but it's still represented in the fund, and it's something that I could see us owning for another, 5 or 10 years, just because, again, we're nowhere near the end of what they could be doing as far as consolidating this industry.
What's the ticker for UFP Technologies?
It's UFP as in Patty, T as in Tom.
Makes sense.
That checks out.
I've got a little note, 2004 to 2007. I've slightly blanked on why I wrote that
was
down. But
running a solo manager hedge fund.
right,
The
right,
experience of
yeah.
that.
Thank you.
Yep. Yes, so between my time at Invesco and my time at Janus, I had a fund from 2004 to 2007. It was a healthcare focused long short fund. And essentially what happened was in 2004, Invesco was consolidated into AIM, which was in Houston. So they moved the operations, the investment team to Houston. I carved out my team and I created a fund company called Silvergate Capital Management. Very quickly got to 100 million plus in AUM. I ran them for 3+ years. The closed it down, and what happened that drove me to close it was there were two investors, they were fund of funds who came together. They were long-termism. They were going to be a great long-term partner for us. Um, 12 months later, they redeemed to go a different direction. And at that point, I was forced to make a decision to gut it out and try to rebuild or to shut it down. There were signs in the market kind of beginning in August of '07 that something was really wrong. Um, just a lot of volatility happening in a lot of strange places that I hadn't seen before. And so I took between August and the end of the year, wound down, and then joined Janus in February of 2008. But I would say that there's the industry back then was very different than the industry today. There were far more fund to funds and other allocators in the landscape. It was much easier to raise money. Fast forward to today, the number of allocators interested in hedge funds, I think, has decreased considerably. Returns maybe have not met expectations, but also you now have private credit, which is, garnering a lot of interest from allocators. The private equity industry is, 10 trillion in assets today. It's much larger than it used to be. So there's a lot more competition, I guess, out there for hedge funds. But to be a single manager, to go out and launch on your own, I think the calculus today is very different than it was in 2004. It's much harder today. The break even is higher. The cost of doing business is higher. It's just a very different environment.
When you look at the market for small value healthcare and more broadly, what do you see? What is it? Where do you feel like we are in the cycle?
I think it's a very attractive backdrop right now. We're in a period of time where small cap has underperformed for what, 15 years? I mean, it's been a long time since small caps have outperformed long or large caps. Uh, we're in a period of time where healthcare has, underperformed for probably the last decade. So the backdrop, I think, is really favorable from a valuation standpoint. I have no problem finding double-digit free cash flow yields. My metric in small cap healthcare right now, they're everywhere. And so I think the starting point for attractive future returns is there. Um, again, we talked about this already, but I think you're going to see more M&A going forward. Since companies acquired out of my portfolio, so about one every 12 or 18 months. And the last four have been acquired by private equity. One of the things that I talk to my clients about a lot is, you know, in the late 90s, when I was at Invesco, we had a venture capital fund. We were one of the early investors in Gilead, for example. And one of the things we always talked about as a team was, the discounts that we were able to source private company investments at. It was very pervasive back then. You never got market price or a premium, always at a discount. Well, you fast forward to today, the private markets, everything's a premium. And what I've seen, it's almost inverted, right? Where in the public markets, nobody wants volatility anymore in their portfolio. So they're willing to pay big prices for what you see privately. But what the result of that is in the public markets, the valuations are extremely attractive. And more broadly, the market structure has changed so much over the course of my career. Jake referenced it. I think the number is closer to 65% of the market is passive now. There are far fewer active investors like me out there sourcing opportunities in kind of 500 million to 2 billion, which is kind of my sweet spot. And then, look on the sell side, there used to be 150, brokers out there doing research on, and many of them were doing it on small cap companies. Today, there's more like 30, maybe 40. So there's just far fewer people doing the work on the area of the market where I focus my time. And so you add all these things up, and it's just kind of created this enormous void where valuations today are really, really attractive. And I would expect private equity to step in and continue to buy assets out of the public markets, I think that's a no-brainer. I would think more strategics will get involved on the biotech or innovation side of things where they need to fill the gap in their own portfolio as their drugs go off patent. But I think the backdrop for the next 3 to 5 years is extremely favorable.
That's very interesting. I've got a question from Lotto Allocator. Why do you think the FDA is demanding an in-house control group on QURE, QURE? Do you have any view there? Isn't the efficiency data versus well-established baseline good enough? Is it too specific? You know what they're talking about there?
Yeah, so Unicure is a very interesting situation. Background, Unicure is developing a drug called AMT-130 for Huntington's disease. If you have any background or knowledge on Huntington's disease, it's a really nasty disease. People are struck with Huntington's in the prime of their life, usually in their 30s or 40s. It's a fast progressing disease. It's incredibly debilitating. You lose motor function, you lose cognitive function. It's really hard on the caregivers. It's really hard on the healthcare system overall. It's an enormous unmet medical need within healthcare. And a lot of drugs have been developed for Huntington's over the years and they've failed. It's a very difficult disease to treat. There are some drugs approved today for Huntington's chorea, for example, which is the tremors associated with Huntington's disease. But there really hasn't been a company that's cracked the code on the underlying disease progression. And so what Unicure did that was incredibly unique is they developed a drug that's delivered via a vector. So you have brain surgery, and it goes deep into the striatum of the brain, and it delivers a vector that will disperse the drug inside the tissue. And what they showed in a group of patients in the fall was that AMT-130 was the first drug to ever affect disease progression. And it did so relatively like in a marked fashion. Like these people, for the first time ever, were going back to work, for example, which never happens. And so Unicure thought they had alignment with the FDA on the development pathway for the product. They were going to use a historical control group as a means to test the progression of the drug instead of historical control. And what happened was in the fall, the FDA came back and said, actually, wait, pump the brakes. We don't have alignment. We are going to require something more along the lines of an active comparator before we approve the drug. And so it's left Unicure in there trying to figure out the path forward. The Huntington's community is up in arms because they thought they had a drug for the first time that was going to treat the disease. The physician community is up in arms because they thought they had a drug. But it's a really unique situation, and I don't know what the outcome is going to be. My best guess is that the FDA is going to relent and somehow allow this historical control group to be the comparator, and then find a way to move the drug forward because the alternative is maybe a multi-year new trial, which I don't think people have a lot of appetite for. I just think there's going to be enough pressure that the FDA is going to relent and allow this to move forward. The unmet need in the market is just too great.
All right, good color. Thanks very much. Andy, we're coming up on time. If folks want to follow along with what you're doing or get in contact with you, what are the best ways to do that?
Yeah, via our website at www.summersvalue.com is the best way, or Andy@summersvalue.com. You can reach out anytime.
Good stuff. JT, any final words?
No, thanks, Andy, for coming on. That was interesting.
Yeah, thanks.
Thank you
Andrew
both for having me. I
Summers.
appreciate the time.
Andrew Summers, Summers Value Fund. Thanks so much for joining us. Folks, we'll be back next week, same time, same channel.